Hello, and thank you for joining us today for our Zions Band Corporation Wealth and Fiduciary Services Financial Market Outlook. I'm Rebecca Robinson, Director of Enterprise Wealth Management for Zions Bancorp, and we'll be joined today by Anthony Valeri, our Director of Investment Management. Anthony will start by providing a review of the economy and our current outlook for the financial markets. Then we'll move to Q&A. So Anthony, I'd like to hand the presentation over to you.
Thank you, Rebecca, and thanks everybody for joining today. Yes, we'll touch on all of those items. First, a little review of performance before we get into the economy, and then we'll touch on some key themes as well for financial markets. When you look at performance for the equity for financial markets, you'll see that developed international bounce back led performance for the equity markets during the first quarter, and you can see that broadly performance for all financial assets was positive. And this is a bounce back from 2022, a difficult year in 2022, and certainly goes part of the way to recoup the losses from that past year. So positive for most asset classes, only commodities lower and have been trending lower since the end of the first quarter of 2022. Bonds also positive, and you can see within equities, domestically, large cap outperformed. We'll get back to that developed international. It's a key point for a takeaway we'll touch on later. Within the equity markets, there was a pretty big disparity among sector performance. Technology led by a wide margin. Communication services also a strong performer, technology related there. And the leaders from 2022, specifically consumer staples, utilities, healthcare, and energy, all were laggards to start the year. So those that underperformed in 2022 outperformed to start the year, a pretty big reversal. One key note there, when you look at the S&P 500, up 7.5% for the quarter. If you take out the big five stocks, Apple, Microsoft, Amazon, Google, and NVIDIA, the performance of the S&P 500 was just under 2%. So an outsized impact from those big five companies and an outsized impact from the technology sector, which we show here. Here is technology relative to the S&P 500. A rising line means that technology is outperforming the broad market. Conversely, a declining line means that technology is underperforming. You can see just how quickly and the magnitude of outperformance of the technology sector in the first quarter. You haven't seen that type of outperformance since the middle of 2021. Ultimately, it did reverse. We think this is too far, too fast for technology, and we don't believe in a concentrated investment portfolio, so we remain diversified. We're also a little bit more defensively positioned with dividend-paying equities. Historically, when we have had a crisis in financial markets, no matter what it might be, it's generally been a short-term negative for stocks. And although the current the news around Silicon Valley Bank has had equity markets be relatively resilient for the most part, outside of a few sectors, of course, but you can see that crises across time historically have led to lower values for the equity market on average for the S&P, and the NASDAQ, which is where your technology exposure is concentrated, has often fared worse. We don't think this is different, so we're a little leery of the strength of that narrow portion of the market during the first quarter. On a related note, the most expensive stocks outperformed during the first quarter of 2023. Given the challenges in the economy, some of the fundamental issues that we're still facing, we don't think this seems contrary, and we're a little leery of this outperformance. What we did is break down the S&P 500 into groups of 5 different buckets, and the most expensive, those with the highest PE ratios, or invest. Conversely, those that were most attractively valued or the cheaper valuations underperform. So again, I think this is a bit of an anomaly given what's happening in the economy, and we'll touch on that in just a moment. Also related to this, cryptocurrencies bounced back strongly in the first quarter. One of the big laggards of 2022, Bitcoin up over 70% for the first quarter. So you see a theme transpiring in financial markets. We think that reverses and normalizes going forward over the remainder of the year. It's been 1 year since the Fed embarked on its Fed interest rate hiking campaign, and the result has been a the most aggressive Fed rate hike campaign since 1980, with the quickest and fastest rate increase that we've seen since then. You can see how this compares to the more recent hiking episodes from the Fed. All of that has put pressure on financial markets. Keep in mind, equity markets are forward-looking and therefore resilient, but it can price a lot of this in. But still, this has put pressure on the bond market, but we're seeing the markets see the end of Fed rate hikes. And how do we see that? Well, inflation is slowing. This has been the key focal point for investors. Overall inflation on the red line has slowed from a peak of 9% down to 6%. We're likely to see continued deceleration. The yellow line is the core CPI, which has also come down. What's putting the Fed in a difficult spot, however, is the fact that the blue line, which is core CPI less shelter, although it's coming down, it still remains elevated and showing that some components of inflation remain sticky. So the Fed's work may not be done here, and that complicates the matter for investors, as they might keep rates elevated even in the face of an economic slowdown. Still, we do expect inflation to come down, and what we try to do is anticipate or take a look at what might the pace of inflation be on a go-forward basis. If we look at what the pace of CPI has been on a month-over-month basis, it's been trending at a 0.3 to 0.4% growth rate monthly. You can see if that pace is maintained, we get down to at 0.3 by the middle of the year. CPI should fall to below 4%, stay close to that for the remainder of the year. If CPI inflation falls to 0.2, we'd get an even greater deceleration, and you could potentially see CPI under 3% by the end of the year. In any case, it's unlikely that inflation falls to where it was just a couple years prior to the COVID pandemic. We're likely to have a higher level of inflation at the end of this, so rates are likely to stay higher. So inflation is coming down, more a question of how quickly rather than if, and that is going to help the Fed. But we have a new challenge in terms of the banking sector concerns, and there's obviously that has been a front and center over the last few weeks. So really the shift has happened not so much from inflation to what happens now to the economy, given what we've seen in the banking sector. First, I'd like to point out that the banking sector is certainly a much more flexible condition, or more liquid than it was in the past. And this measures loans and leases and securities as a percentage of deposits. You can see that those loans, leases, and securities are a much lower percentage than they were in the recession in the early 2000s, also compared to the great financial crisis in 2008. You can see that even with some of those deposits coming out of the banking sector, whether it's large banks or small banks, that loans, leases, and securities remain a relatively lower percentage of deposits than has historically been the case. That gives banks a lot of flexibility to weather this storm. And really, I think you have to wonder now, with this focus on the banks, what are the knock-on effects? What happens as banks will likely focus, probably rein in lending to individuals, businesses, and the economy. And that to me is the greater risk. What are the knock-on effects to the economy? The banks are cheaper, financial instruments are cheaper related to the banking sector. But what about the rest of corporate America? And you are seeing knock-on effects. This is a headline from Bloomberg News on March 15th. Banco Santander halting a subprime auto loan bond deal that was backed by auto loans for subprime borrowers. Just one example, but this is where you're likely to see more banks retrench, and that is going to cut off the flow of credit to the economy, which could accelerate the onset of a recession. So I think this is the greater risk. What is the broader implication to the economy from banks restricting credit? Well, the bond market has factored some of this in. This is the market-implied path for the overnight Fed funds rate. You can see that as of March 9th, before the banking crisis, the market had priced in an increase to over 5.5%, and has done a complete U-turn now, with futures now basically saying the Fed is done. Slight probability of an increase at the May 3rd meeting, but the futures are indicating that the Fed is likely to cut at least once by the end of the year, maybe twice, with rate cuts proceeding into 2024. So a dramatic shift in Fed rate hike expectations. I think this fear will shift away from the Fed and ultimately the path of an economic slowdown. Speaking of the economy, the labor market is still firm. This is the job openings data from the U.S. Treasury, known as the JOLTS data, showing the number of job openings. This chart on the left was before yesterday's release, which showed job openings falling more than expected to under 10 million. That's still a big number and high relative to history, but at the margin, that should give the Fed some relief that their rate hike campaign is doing its work. We saw two-year Treasury yields fall lower after that release. The voluntary quit rate actually ticked up, meaning that workers are still feel confident enough to leave their job. But on balance, labor market firm, but starting to see some softness, and weekly jobless claims still very, very low. One of the best leading indicators for a recession, not increasing, not showing any signs of weakness. We do think that changes over time, but so far, I really hope seeing the labor market hold firm, which is the key to consumer spending. One pillar of the economy that had held up well, but now starting to see some weakness, business investment, still positive on a year-over-year basis, but you can see the deceleration in this metric, business investment slowing. Again, that along with consumer spending had been holding up the economy, but slowing now as well. So the economy losing some momentum, and I'll tack on another indicator that came out this morning, the ISM Services Index. The service sector had been that bright spot for the economy. Was weaker than expected, still in expansion territory at 51 and change, but that sharp slowdown also concludes that the economy is losing momentum here at the end of the first quarter. The message from the financial markets in terms of the yield curve from the bond market is that the yield curve has started to steepen again. And again, we measure this as the yield differential between the 10-year Treasury yield and the 2-year Treasury yield. When it's negative, the curve is inverted, and we still have that situation now, but that gap is narrowing. And usually when it narrows or the curve steepens, that means we're that much closer to a recession. And when that happens, it means you're closer. It also favors bond performance, bonds over stocks. Bonds have typically outperformed during that environment, but you can see here how ahead of all of the prior recessions, the yield curve has steepened. And if I translate that to what the performance is, now granted, this is a small sample size, but I'll look back at prior instances when the yield curve has begun to steepen after peak inversion. You see that bond performance is measured by the Bloomberg Aggregate Bond Index is stronger on average versus the S&P 500 or the equity market. This doesn't mean you should avoid investing in equities, but it does favor bonds over stocks, or at least taking a cautious view in the equity market. So reason to be cautious based on that inversion. And if you need more, or what makes us still stay conservative in our equity allocation, is that valuations aren't necessarily expensive or cheap, but they should be cheaper in our view, given the challenge, the potential slowdown in recession risks in the economy. This is the equity risk premium, which basically takes corporate earnings and you divide that by the S&P or a price index like the S&P 500. You get a yield, and you compare that to the 10-year Treasury yield to see whether stocks are more attractive to bonds or vice versa. Right now, it's showing that bonds are slightly more attractive relative to stocks. Again, when this line is higher, that's a better time to buy equities and vice versa. Just one indicator to show that stocks aren't necessarily cheap here, while even if they aren't expensive. So you have to take that, in our view, take a little more conservatively as you position in the equity markets. Here's the consensus forecast for 2023 corporate earnings for the S&P 500. Over the last half of 2022, those corporate profit estimates have come steadily lower, and despite stabilization to start 2023, they're still coming lower. As it stands today, corporate profits are expected to be flat to down 1% on a year-over-year basis, and that's before we anticipate much of the impact from what banks will do. Again, I think there's some downside risks here, and that the potential for weaker corporate profits not factored into equity prices. So another headwind for equities. Negative earnings don't necessarily mean a negative return for the stock market. It does suggest more muted returns, however, as we go forward. So why invest in stocks with all of the challenges to the equity market and the economy coming forward? Well, first and foremost, remember the equity market is a forward-looking mechanism, and much of the damage in 2022 was in anticipation of some of the news we're getting now. The other is that most investors are positioned defensively. There is a lot of negativity out there in terms of recession risks, bearish market sentiment. This is the American Association of Individual Investors. It's the net bullish sentiments from their weekly survey of investors. And you can see that the bullish investors are at a historic or a period low here. Lots of negative sentiment that can often act as a contrarian indicator. We also track hedge fund positioning, which shows that they are underweight equities relative to their targets. And institutional investors, based on recent surveys, are also underweight equities to their relative targets. So that lack of positioning in equities provides some underlying support. That's why this market's been resilient. Really hard to time these sentiment changes. But again, it goes to show you how this sentiment is providing a supporting role for the equities. I'm also going to go back to the first slide here where the international developed equities outperformed for the quarter. They've actually outperformed for the past 6 months. If you'll recall, at the end of September, I don't think the outlook could have been more dire for a particular asset class than international equities. Gas prices were on the rise. The Russia-Ukraine war was still, as it is today, front and center headlines. There were expectations of a severe recession expected to hit Europe this winter. Well, lo and behold, a mild winter, a good job storing and saving gas, and Europe has avoided recession altogether. You never know what's going to happen. That's why you should stay invested and stay diversified. So a perfect example with regards to European or international developed equities to remain invested. If I could have one more point on that topic, if we do have a recession, remember that stocks bottom before the end of a recession. Here are all of the recessions from the end of World War II, when they started, when they ended, how long the recession lasted, and when the market low occurred. You can see on average, the market low occurred 4 months before the end of a recession. And not only did it end before the recession was officially over, but the returns from that market low to when the recession ended are very strong, up 26.5% on average. And keep in mind, we don't know when the recession ends until the National Bureau of Economic Research puts out a proclamation to say that it's over. That comes out anywhere from 2 to 8 months typically after the end of a recession. So trying to wait for that all clear has not been a successful investing strategy. Within the bond market, we have increased credit quality along with our changes that we've made and more recent changes in our portfolio. Here is the Fed Senior Loan Officer Survey showing the percentage of banks tightening conditions. This is data from back at the end of January. So we expect that blue line to go even higher. You can see how the average high yield bond spread correlates very well to this series. It's a pretty tight correlation. What's not shown here is corporate defaults. They also track closely to high yield spreads, albeit with a lag. This basically tells you that the high yield bond market should be pricing in a greater cushion in the form of a greater yield advantage relative to treasuries. And what we basically have is an average yield spread in the high yield bond markets. So we're a little cautious on lower rated bonds. We're focusing on higher quality bonds, given the challenges near term and getting neutral in terms of interest rate sensitivity. So one more data point that shows markets aren't fully braced for a slowdown or a recession. Those are my prepared comments. Thanks everybody for joining. Rebecca, I will turn it back over to you.
All right, thank you, Anthony. And we have a lot of questions, so we'll go ahead and jump to it. So Anthony, as you can imagine, with everything that has gone on in the industry the last few weeks, we have a lot of questions around the bank and also sort of the banking sector, and then some specific questions about what we're doing within our investment portfolios, how those assets are considered in the bank, or segregation of those assets as well. So really a lot of questions around just the bank and banking industry in general.
Yeah, I think first and foremost for our investors, as you mentioned, we segregate assets on our platform, meaning that those assets are held separate from those of the bank. We have a separate account at Depository Trust Company where we hold those assets in client name. So in the very unlikely event of a bank failure, those assets are protected, they're kept separate. They remain there in the client's name until either an acquirer comes in or it's transferred to a different custodian. So it's an extra layer of protection, more so than the typical brokerage SIPC insurance. And I think it's been a differentiator for us. In terms of the banks overall, our bank, we've had a very diverse customer base, 1.4 million depositors, 52% of our deposits insured, roughly in line with the banking average. And for those that have looked through our 10K, you'll notice that our loan book, we don't have more than 10% exposure to any one category of loans. So I do think that that is a differentiator for us. And as I mentioned in that slide earlier in the deck, that banks generally have a lot more flexibility in the current environment.
That's great. Thank you. So our next question is around sector and asset class selection specifically. So during the presentation, you discussed which sectors performed well previously, but this question is really maybe you looking forward to say, which sector do you think will lead the market? Large cap, small cap, technology, healthcare? How do we go about considering that when we think about portfolio construction?
So we like to take, that's a good question that comes up a lot, Rebecca. We like to take a diversified approach. We don't like to overweight any one area of the market to our detriment. You never know when you can be surprised, and that can lead to significant underperformance that is hard to recoup. So right now we do have a slight bias towards dividend paying equities and a little bit toward what we call value categories. Just to remain defensive, we want to stay invested, but given some of the challenges, we think that's prudent over the coming year.
That's great. So we have a couple of questions, really, I think, around protecting portfolios during times of volatility. We had a lot of years where things seemed to just like go up, and now we're seeing the return of volatility. So this first one is another one of these questions. What are your thoughts on owning silver and gold?
That's more of a trade, and one, yes, we are getting more of. It's hard to value precious metals like silver and gold. They don't generate earnings, they don't pay a dividend. During times like this, you do get some interest in it given the volatility, but it's a short-term trade and really hard to time. I don't think it's been an effective, either silver or gold, been an effective portfolio complement. We'd rather have bonds in there as a hedge against risks and an economic slowdown. Again, I view it as a trade, not something to be part of a long-term diversified investment plan, even if it does work short-term.
All right. And along these same lines, you talked about certain investors being underweight in equities, but you also mentioned kind of the difficulty in timing the market. So this specific question is it time to rebalance my portfolio to protect assets? Is it time to move to cash? So when we're considering moves like that, what are the things that we ask someone to consider before making that type of change?
Yeah, well, first and foremost, what is your investment plan? What is the goal of this money over time? And you can see where people make adjustments if their goals or risk horizons have changed, get more conservative or more aggressive, if the case may be. Would not go to cash based on that as part of that question. That involves timing the market, and with the international developed stocks example I gave, impossible to do. That means you have to get it right twice on the way out and on the way back in, which nobody has done well, even the most successful investors in our field. So we try to avoid that altogether. Stay invested. If it is too much volatility for your taste, maybe shift down to a less volatile portfolio. But we do suggest to remain invested. Don't time the market. You should, if you're going to be invested in equities in a diversified portfolio, it's to help fund the longer term goals, 3-5 years and longer. So don't try to time the market or try to get cute, because that ultimately leads to weaker performance.
Anthony, I think there are statistics that even tell us just missing a few of the best days has a really long-term impact on your portfolio.
It does. Just missing 5 of the best days. We have another stat that we can talk about with clients, that 60% of the strongest days in the equity market come during bear markets. And it's really important that you may think that, well, I'll avoid the bear market altogether. Well, it's those bounce backs from depressed prices that really help your longer term return. If you just stick around for the weakness, you won't benefit from those up days. So really important to just weather that storm.
Yeah, and this other question, I think, kind of goes along with the same thing. You talked about some of the Fed rate hikes, which means we're also starting to see cash and CD returns much higher than maybe they've been. One of these questions is, are CDs better than the stock market? So the idea, should I just be moving to CDs right now? It's kind of this waiting it out question, but what are your thoughts around the returns on CDs now, and if those are attractive to people?
They're certainly higher. I think they should not be part of a longer term investment plan. It seems attractive now, but if the Fed does follow through with rate cuts as futures imply, and futures have been wrong, but if they do follow through, then those rates are going to be coming down. In the meantime, there is strong data to show that intermediate bonds have historically done very well when the Fed is cutting rates. So in that particular case, you're going to miss out. So it's, again, another timing situation, trying to get back in. Yes, that might sound comfortable, but if you have a strong performance in the bond market, or the markets bounce back because a recession doesn't materialize or isn't as severe as anticipated, then you lose out. So I would treat that money separately, use that for your short-term funding needs and not a long-term investment plan.
Yeah, that's great. One of the questions is really around the move of certain countries to be pulling away from the US dollar. Any comments on that? Things that cause concern from an investment perspective?
Yes, the multiple headlines here, the Saudis working with the Chinese, buying oil in yuan, not dollars, China brokering other peace deals, and that's come in the headlines again. We don't see an end to US dollar dominance. It could happen, but it's going to take decades. Over 60% of world trade still denominated in US dollars. It just isn't a replacement for the US dollar. No currency is as deep or as liquid. The next greatest is the euro, I think right around 20, and that's actually come down as a percentage. So there's there isn't a viable alternative. And historically, over the past 20 plus years more, the correct view is to fade those concerns over the US dollar. So no, I don't see a replacement to the US dollar despite those recent headlines.
Well, and I think this goes to, we oftentimes see things in headlines, but the difference in a long-term investment strategy versus what's happening maybe in the short term. It's a short-term thing to consider and something to watch, but doesn't necessarily change your long-term outlook.
No, it doesn't. And keep in mind, US dollar last year reached a historical high. And so I think, yes, some weaknesses to be expected here, just given how stronger the dollar was leading into last year.
All right, and one final question, and we all think about recessions and the headlines around recessions. And I think earlier you mentioned the labor market is still strong, one of the things that maybe indicates we're not heading that way, but then there's some other factors that may be slowing. And this question is, do you see the economy slipping into a full-blown recession within the next 9 months? And I think it might be interesting to comment on what a full-blown recession might mean. But then also, do we see that on the horizon?
Yeah, so we do look at that within the investment team, and our expectation is, greater than 50% that we do have some form of a recession, probably a light recession, but we don't know for sure. We put that probability in the 60 to maybe 70% range over the coming 12 to 24 months. So we do think that there is a significant risk. You'll get that general rule of thumb that it's 2 quarters of negative GDP growth, but it doesn't necessarily have to be that. We will get some decline in GDP as a result of a recession if we do have one. Again, we're biased towards more something on the mild side in terms of a recession, but again, very hard to time, and we don't know if that, and certainly not a given by any stretch.
And when we think about a recession, then does it still change the way we think about long-term investing?
It doesn't. I think over the long term, the odds of being invested in stocks, you're usually rewarded. 75% of the time, any given year, you will have a successful or positive outcome. Over 15 and 20 years, returns of stocks have never been negative. So when you think longer term, it's best not to try to time these events. And again, with that chart I showed on the recession timing, some of your best buying opportunities come during a recession. So as painful as it might be, just think about the long term and staying committed to that investment plan.
All right. Well, Anthony, we are out of time. Thank you so much. Very thoughtful as always. And thank you to all of you for being valued clients and for joining us today. After this webinar, we'll distribute a communication that will allow you access to this recording if you'd like to review it, or if you'd like to share it with others. And we will see you for our next webinar, which will be held in July. Thanks so much for joining.